Good morning and welcome to the Killik & Co market update. It's not been the best of weeks for markets. Here we've got a two-year chart of the S&P 500 and you can see the decline that's happened over the course of this month. There are a couple of reasons for the market weakness we've seen this week. The first is the latest minutes from the Federal Reserve, which suggested that interest rates in the US might remain higher for longer than previously thought. Markets are now pricing in higher US interest rates until the end of 2024. The other reason for the market weakness is concern about the Chinese economy. This week, Evergrande, which is the largest property company in China, filed for bankruptcy protection in the US. There's then another major Chinese company called Country Gardens, which has failed to pay interest on some of its bonds, and this week it suspended trading in some of those bonds. And then finally in China, there's a major investment company called Zhongji, which looks after about $137 billion worth of investments for retail investors. And this week, that company stopped paying income to investors on some of its products. So we're waiting to see what the Chinese government will do about this. But it's not all bad news this week. We have had some better than expected results from the US retail sector, showing that consumers in the US are still willing and able to spend. Here we've got retail sales in the US over the last 5 years, and if we look at the most recent data point in green, you can see it's noticeably higher than the previous data point, which was a pleasant surprise after several months of declining numbers. Also this week, we've had results from TJX, owner of TK Maxx, and Walmart. Both of these low-cost retailers beat expectations, and actually share prices of both companies have beaten the S&P 500 on a two-year basis, as you can see by this chart here. So do give us a call if you'd like to talk about our views on US retailers. The Russian ruble has been in the press this week after hitting a significantly low level of 100 rubles per dollar. Here's a 3-year chart, and you can see it plummeted just after the invasion of Ukraine when the West started imposing sanctions. Then Russia asked buyers of its energy products to pay in rubles instead of dollars, and some countries complied with this, and this created a forced demand for rubles and pushed up the price. Since then, there has been a steady decline. Energy prices have fallen, so less rubles are needed to buy the energy. Many countries are moving away from buying Russian energy products at all, and nobody wants to hold the ruble unless they have to. It's a currency that's tied to an economy that's struggling under the weight of Western sanctions and the high cost of the ongoing war in Ukraine. The dynamic between Russia and China will be interesting here. Both countries are in need of funding, but at the moment they can't really afford to help each other because their economies are struggling. And finally, the Office for National Statistics has released its latest data on birth rates in the UK. Birth rates are increasingly being used as an indicator of future economic growth. A high birth rate will lead to a young population with more people in the workforce. A low birth rate will lead to an aging population with more people being dependent on the state. India, for example, has a relatively low median age of its population at 28. China, on the other hand, has a much higher median age of 38, following many years of its one-child policy. So at the moment, the Chinese government is desperately trying to encourage people to have more children in order to boost the future economic growth rate. Birth rates are currently declining across much of the West, and the UK is no exception. Here's the data for the UK. You can see the spikes in 1920 and 1947 following the 2 world wars, but the trend since then is clearly a downward one. Next week, we've got results out from Nvidia, which are highly anticipated given how much the stock has come up since last year. That's it from us. Enjoy the weekend, and we'll see you next Friday.